didn't have ETPs. There was a time we couldn't trade commodities, and there was a time when bond trading was almost non-existent. Now we have ETPs. Now you can have bond trading. Now you have platforms like FMDQ, you have NASD, you have FX. You can trade on listed public securities now than before. In other words, we are better now than we used to be. Are we there yet? Of course, no. Nobody's there yet. There are many reasons. You mentioned some of those factors. Liquidity can still be very low. We still have 170, 171 companies that are listed. A lot of them are not representatives of the economy. You can't compare us with some other countries like South Africa and the rest. There are so many things that we can improve on. And that way, we can say that monetary policy, fiscal policy can also be very beneficial. Let's just look at fiscal policy, for instance. We all know from our elementary economics that it will be expenditure, it will be revenue, it will also be deficit. Not only that, but the assumptions and the policy and programs of those items, as well as how the deficit will be financed. Those are things that can impact on the capital market. And most times, this impact can be directly on the capital market. For instance, the government buys directly from companies that are listed on the stock exchange. Of course, you expect their profitability to increase, then you expect their share price to perform better to the extent that fundamentals determine the stock performance of those companies, as Professor understands very well. If government also spends such money on the provisions of infrastructure generally, which can reduce the overhead and then increase productivity, reduce cost of doing business, it's also engender performance of companies as well as their stock performances. Another aspect that fiscal policy can affect the market is in terms of the macroeconomy. Of course, from our maybe 100 or 200 level economies, we know that GDP is a function of consumption of individuals, government, investments, exports, and minus the import. So when government injects money, you expect that there will be growth, and when there is growth, capital market tends to do better when the economy is moving forward in the long run. Of course, we understand that when you are in recession, the capital market also went down. So fiscal policy, to the extent that it drives the economy, it can also drive the capital market indirectly and also directly. We should also not lose focus, however, of the impact of government deficit, because that one can have it's a two-edged sword. It can save, it can also harm, in the sense that when government does deficit financing, which means that the budget is expansionary, which may be good for growth, government needs to finance the deficit. And most of the time, in the context of our own economy, government needs to borrow. And when government wants to borrow, there are many areas where the capital market can be useful. And those areas, capital market will benefit, and there are also other areas where the capital market can suffer. When government borrows through the debt market, definitely, as he said, the debt capital market may be benefiting. However, because everybody likes government is risk-free, apart from inflation risk and some small risks. You tend to leave equities market and then come to the debt market. So most of the time, when we just do a partial analysis of the capital market by looking only at the equity side, we may say suffering, but we may also need to balance that by looking at the debt capital market, what is happening there. Another thing is that because government will be issuing securities, even when private companies are ready to issue their own bonds, of course, if government is issuing bonds at 16%, the private must issue 16 plus because of their risk. So it then crowds out private investment, as we know. So when government has deficit financing, which can be expansionary budget, which can be good for growth, it may also harm the equity segment of the market, crowd out private investment. So we need to really sit down and then see, we can have a plus on one side and have minus on the other side. How do we balance some of these things? And there are quite a number of things that the fiscal authority can do. And as he said, we understand that in such a situation, especially for economy that are fiscally dominant, all over the world, it has been found that economies that are resource dependent, especially oil, when the money comes in, they are likely to be fiscally dominant. So most of the time, the hands of the central bank or the monetary authority will be tied. As he said, it's going to be the unholy trinity or the trilemma. How do you balance capital accounts liberalization with your independence of monetary policy as well as a stable exchange rate? So in this case, we all understand that what the central bank chooses is that, okay, let there be free flow of money, let there be some kind of stability in the exchange rate, but independence in terms of being able to adjust interest rates the way you like, your hands will be tied. So it's understandable, you can only pick 2 out of the 3. But since the economy somehow is stabilizing, inflation, as you said, 11.6 and is falling, hopefully. Reserve touching 48 billion. Exchange rates relatively stable. Oil price $75 to $78 per barrel. We expect that, of course, central bank will be considering lowering interest rates. But also, that is a function of how much government wants to borrow in the economy and things like that.
Falabi Olowokere, who is the divisional head in charge of economic research and policy at the SEC, speaking after Suleiman Danusa, former Director General of the SEC and former chairman also of the Securities Commission. Let's get back to the market, of course, the discussion about that. Look at the NESD over-the-counter market after 2 days of being lackluster, still in part, no movement. We saw that 0.38% on the unlisted securities index. That's 657.95 you're looking at on your TV screen, way below the 600 600 psychological reading on that NESD over-the-counter market. And the market cap for this unlisted small market was about 445.25 billion on Thursday. What does the primary numbers look like? That's about 390,000 transactions. That's a very big jump since we started the week on the NESD. That's for 8 million naira in 12 transactions. Wrap it up with me as we look at the fixed income space. And that's your treasury bills via the FMDQ. OTC exchange, we went down to double digits. At the bottom of the page there, you can see 78.28 billion naira in total. That's on the day after the debt office rolled out a reopening of the 68 billion naira dated papers, wrapping up the month of June and the second quarter and the first half of the year. As far as the debt offer is concerned, we're now looking effectively at what happens in the month of July and the second half of the year. Bring it on, you see the Naira bond, the four most actively traded, both of them, the 4 of them were midterm papers, 2020, 2021, 2027, and 2028. 2 short-term, 2 midterm paper. In total, the total transactions for that space was quite huge, and that's the highest figure we've seen so far this week, 22.95 billion naira. When we come back, it was horrible, it was horrific, pure horror in Lagos yesterday evening, closing of business, and folks were burning. We'll be right back into. You're watching Business Morning.